Hey, we'll talk about a couple of steps to investing for beginners. Stocks, bonds, or real estate. Which path should you take? So, you've decided to dip your toes into the world of investing. First off, congratulations. Taking control of your financial future is one of the smartest moves you can make. But here's the thing. With so many options out there, it's easy to feel overwhelmed. Should you dive into the fast-paced world of stocks? Play it safe with bonds? Or maybe go big and invest in real estate? Don't worry, I'm here to break it all down for you. By the end of this chat, you'll have a clearer idea of which path might suit your goals, risk tolerance, and lifestyle. Let's get started. Let's kick things off with stocks, the flashy rock star of the investing world. When people talk about the market, they're usually referring to stocks. Here's what you need to know. Stocks represent ownership in a company. When you buy shares of a stock, you're essentially buying a tiny piece of that business. If the company does well, your shares could increase in value, and you might even earn dividends, a portion of the company's profits. Why invest in stocks? Potential for growth. Historically, stocks have offered some of the highest returns compared to other asset classes. Liquidity. Unlike real estate, stocks are easy to buy and sell on exchanges like the NYSE or NASDAQ. Accessibility. Thanks to apps like Robinhood, Acorns, and Webull, you can start investing in stocks with as little as $5. The catch. Stocks can be volatile. Prices swing up and down daily based on everything from earnings reports to global events. If you're not prepared for short-term fluctuations, it can feel like riding a roller coaster blindfolded. Who is it for? Stocks are ideal for beginners who are okay with taking risks and have a long-term mindset. Think 5+ years. If you want excitement and growth potential, stocks might be your jam. If stocks are the thrill seekers of the investment world, bonds are their chill cousins. They're predictable, reliable, and often boring. But sometimes boring is exactly what you need. What are bonds? Bonds are essentially loans you give to governments, municipalities, or corporations. In return, they pay you interest over time and eventually repay the principal when the bond matures. Why invest in bonds? Stability. Bonds tend to be less volatile than stocks, making them a safer bet during economic downturns. Income stream. Bonds provide regular interest payments, which can be great if you're looking for passive income. Diversification. Adding bonds to your portfolio helps balance risk, especially as you get closer to retirement. The catch. Bonds typically offer lower returns compared to stocks. Additionally, inflation can erode their value over time, meaning your money might not grow as much as you'd hoped. Who is it for? Bonds are perfect for conservative investors who prioritize stability over high returns. They're also a solid choice for older investors nearing retirement or anyone building an emergency fund. Real estate, the tangible brick-and-mortar option that has created countless millionaires. Whether it's flipping houses or renting out properties, real estate offers unique opportunities, but it's not without its challenges. What is real estate investing? Real estate involves purchasing property to generate income or appreciate in value. This could mean buying residential homes, commercial buildings, or even investing in REITs, real estate investment trusts, which let you own shares in real estate portfolios without directly owning property. Why invest in real estate? Tangible asset. Unlike stocks or bonds, real estate is something you can see and touch. There's comfort in knowing your investment exists physically. Passive income. Rental properties can provide steady cash flow month after month. Appreciation potential. Over time, property values often increase, allowing you to build wealth. The catch. Real estate requires significant upfront capital, ongoing maintenance costs, and hands-on management, unless you hire a property manager. Plus, it's illiquid. You can't sell a house as quickly as you can sell stocks. Who is it for? Real estate is best suited for patient investors willing to put in the work or money to manage properties. It's also great for those seeking diversification beyond traditional markets. Now that we've covered the basics, how do you decide where to put your hard-earned cash? Here are 3 questions to guide your decision. What's your risk tolerance? If you're comfortable with ups and downs and chasing higher returns, lean towards stocks. If you prefer stability and predictable outcomes, consider bonds. If you're somewhere in between or love the idea of owning physical assets, try real estate. What's your time horizon? For short-term goals, less than 5 years, avoid stocks due to their volatility. Bonds or high-yield savings accounts may be better. For long-term goals, retirement, kids' education, stocks and real estate shine because they benefit from compounding growth. How hands-on do you want to be? Stocks and bonds are relatively hands-off once you set them up. Real estate demands more effort, whether it's finding tenants, handling repairs, or navigating legal issues. Bonus tip: don't put all your eggs in one basket. No matter which route you choose, remember the golden rule of investing: diversify. Spreading your money across different asset classes reduces risk and increases your chances of steady growth. For example, a young investor might allocate 70% to stocks, 20% to bonds, and 10% to real estate. An older investor nearing retirement might flip that ratio, favoring bonds and real estate for stability. Here's the truth: there's no perfect investment. It's all about finding what works for you. Stocks offer explosive growth but come with risk. Bonds provide stability but slower returns. And real estate gives you tangible assets but demands more effort. The most important thing is to start, no matter how small. Even $50 a month invested consistently can snowball into something substantial over time. So pick a strategy, stay disciplined, and watch your wealth grow. Ready to take the plunge? Tell me, what's your first move going to be?